What if you could use your retirement funds to buy a business without paying a dime in taxes? That's right. No federal, no state, and no early withdrawal penalties. That's exactly what Benetrends ROBS makes possible. ROBS stands for Rollover as Business Startup. What if you could convert some of your retirement funds to a Roth IRA, buy a business, and avoid paying taxes on the future sale of that business? That's exactly what Benetrends ROBS Plus makes possible. In today's episode, we're joined by Scott Thorell, Chief Financial Officer at Benetrends, and Kristen Gordon, Senior Consultant. We're unpacking a funding strategy that turns your 401k or IRA into a launch pad for business ownership. We'll explore how it works, who it's for, and why their enhanced ROBS Plus structure is helping entrepreneurs not just start strong, but exit with maximum tax efficiencies. Whether you're looking to fund a franchise, buy an existing business, or start something new, this episode could change how you think about your retirement funds forever. Welcome to Pursuit of Profit, the podcast that cuts through the hype and gives you the real story on franchising and entrepreneurship. If you want honest conversations, tough truths, and practical advice to build wealth, take control of your future, you're in the right place. I'm Cliff Nonemacher, host and co-founder of Franchisee, where we help aspiring business owners find the right franchise and avoid costly mistakes. We talk about what others gloss over, the failures, the pitfalls, and the behind-the-scenes moves that make or break your success. Whether you're just getting started or deep into the process, this is your go-to source for unfiltered insight. Let's get into it. All right, welcome. I appreciate you folks coming. I can't thank you both enough coming on the show. And today is all about Benetrends, ROBS, and then I want to get into this ROBS Plus because I truly believe that the audience will benefit greatly. Number one, no one even knows it exists. And once they start to hear what it can do for them, it's a game changer. So let's begin with who exactly is Benetrends?
Yes, there's really a variety of funding options that are available to suit every entrepreneur's unique funding needs these days. So our team at Benetrends specializes in working with candidates who are exploring business ownership, and we want to work to help them identify potential funding solutions. And particularly over the last 40 plus years, we've assisted those looking to utilize retirement assets as part of their funding strategy.
That's great. Love it. Just for the audience, I've been working with Benetrends for over 20 years, which is just incredible. You have done hundreds, if not in the thousands of ROBS, SBA loans over again, a 20 plus year career. So I think the world of you folks. I think you're the best in the business. So just go through real quick the litany. Like, do you do home equity loans? Do you do unsecured lines of credit? What are the services exactly that you offer at Benetrends?
Yeah, we specifically focus on SBA lending, packaging those small business administration loans, and the rollover as business startups process. And our strategy that we're going to dive into a little bit deeper today, the rollover as business startups or ROBS Plus program.
Hate the name. I know you do too. You have to hate the name. I think it was affectionately named by the IRS. Is that true?
That's what the rumor has it.
That's right. And it's a crazy name, but it's the most brilliant tax strategy. Let's, for the audience, just explain. We'll begin with the ROBS, the ROBS. Explain it. Explain the ROBS.
The rollover as business startups process, or that ROBS for short, enables those entrepreneurs who are looking to pursue or capitalize a business even to use those qualified retirement funds, tax deferred and penalty free. And it's a process that can work in combination in certain situations with other financing tools like an SBA loan. And, I think we can really summarize how the process works at a high level in 4 steps. Step 1, we're going to establish a C corporation with a customized retirement plan. Secondly, we're going to roll over existing retirement funds into the C corporation, into the C corporation's retirement plan. Thirdly, that new retirement plan is going to purchase stock in the C corporation. And lastly, that corporation is funded, and that capital can really be used then to purchase or start that business. And using those principles are how we can open that door to that capitalization strategy we're calling the ROBS Plus program.
That's awesome. So I'm taking, let's start with an IRA, or I quit my job and I have a 401k rollover. I could take my 401k rollover. I can roll it into what? What am I rolling it into?
So we're going to form a corporation for your new business, right? You're starting that new business. Your corporation is going to sponsor a new retirement plan. So that 401k that you have, we're going to roll those funds from that 401k into that new corporation's retirement plan. Once those funds land in that new retirement account, we're going to have that new plan purchase the stock of that newly formed corporation. And as a result of that stock sale, your corporation now has that capital to use for those business expenses.
Love this. I've explained to people, I'm like, if you have 100 grand in your checking account, how much do you have? They go 100 grand. So you take 100 grand, you buy a business. Let's just say you fail. What did you lose? I lost 100 grand. I go, how much do you have in your IRA? And they go, I have 100 grand. And I go, no, you don't. That 100 grand is not your money. 70 cents on the dollar is a maybe, 30 plus cents on the dollar doesn't even belong to you in an IRA or a 401k, et cetera, et cetera. Why would you not speculate to accumulate wealth using a retirement plan? And illiquid, by the way, this is illiquid money. Everyone knows that you can't touch it. I got to retire, have to be 59 and a half, and so on and so forth. This gives people the ability to use their life's work, right? The illiquid investments that they never refer to invest in themselves. Instead of a mutual fund, instead of stocks and bonds, they're investing in them. And I love this tax strategy where the state, in many cases, the state and the federal government are literally contributing to this transaction because it's their money at the end of the day. 30 plus cents on the dollar really doesn't belong to the business owner. I just love this tax strategy. And once someone's mind is expanded by new ideas, it does not go back to its original shape. And people like, holy crap, the rub is this. Cliff, that was brilliant. Called my broker. He says, I can't do it. I'm going to do, he says that I'm only 35. I'm only 48. I'm only 50. He said, I'm going to pay an early withdrawal penalty. Go ahead, address that.
Yeah, we hear it all the time. And it's long standings of the Employee Retirement Income Security Act that make this program possible. And it'll allow those entrepreneurs that are thinking on that track, hey, we can use this money tax deferred and penalty free.
Unbelievable. Zero tax ramifications, folks. You're taking an IRA, 401k rollover. Stop me, 457, 403B, right? Anything coming out of a former employer as a quote qualified retirement plan could be used for the rollover as a business startup strategy, correct?
Yeah, there's quite a few qualified retirement plans.
That's right. I love this. I do.
And we've been doing it for over 40 years now as well. So it's not as if this is something brand new. You know, our owner came up with this 40 plus years ago. And
Scott, I appreciate you saying that. I appreciate you saying that because people don't understand that ERISA was created in the 70s. And that this tax strategy has been around since the 70s. It was your company that said you could have a tax strategy, but there's no vehicle to implement it, to execute the strategy. Your company came up and said, we need to create the framework so people can benefit from the Employee Retirement Income Security Act of the 1970s and make this a reality. And that's what I love about Benetrends, out of the box, you know, just leveraging collective intelligence, really getting into the model and making this affordable for just everyday people without this being reserved for only the, you know, ultra rich. Anyone can do this. What would you say is the minimum amount of money to be used? Because a lot of people ask me and go, well, I have $1 million in my IRA. I don't want to use all of it. You don't have to use all of it. Go ahead and address that issue.
No, I think the amount that the entrepreneur needs is individual to their situation, what they have available, what the business is going to require, right? So it's not uncommon for us to see entrepreneurs start to leverage this program around $50,000 and upwards.
50 and up. Okay. What happens when I sell the business with a ROBS? So is it still tax deferred investing where if I sell the business, that investment, the proceeds go back into my IRA rollover?
Right. You're going to roll those in some cases. I mean, there's different ways to sell a business, right? But in some cases, those retirement funds or the proceeds from that sale are going to roll back into that retirement plan, which you can then roll into a vehicle such as an IRA and take those funds out when you reach your typical retirement age. And of course, then you're going to pay your taxes as you should.
Okay. This is my life's work. Let's just call a retirement plan your life's work. How do I prevent my employees in the future from participating or having access to those funds?
There's eligibility requirements in a retirement plan, right? And as we're customizing that retirement plan, we can design those eligibility requirements within what the law allows to allow for participation of your employees within that retirement plan.
Okay. I refer to it as like you're legally discriminating against an employee. Is that like, would you use that word to, like it's legally, I'm creating a fund. The enrollment window is a day. I'm exaggerating. So I create this C Corp, I create this retirement plan. I take my life's work, money, and put it into this retirement plan. I have an enrollment window open for a day, a week. I look around, I have no employees, window closes. Is that a fair word picture of what we're doing so that my newly hired employees don't have access to my retirement funds?
But let's be clear, they're not accessing your retirement funds, right? They are participating in the plan that has been established for your company. So your funds are your funds. That's not being accessed by any of the employees. What you're doing is really using this as a tool at any company that would use it as a recruiting tool or a retention tool to say, hey, I have a retirement plan. So you can invest your money into a 401k, or you'd potentially be a participant in a profit share, which will again be at the discretion of you as the owner. But there's nothing that says that you have to make it a profit share versus a 401k, or that you had to do a match. You just have to make it available to those employees that are eligible based on the plan design. So instead of looking at it as a threat, you really look at it and say, well, I'm starting this franchise and I'm actually creating this plan that my employees, if they want to, they can sign up and participate in. And potentially that's an opportunity they won't have if they go down the street.
Okay. I like that. All right. That's great. Most people don't get the full story when they start exploring franchising. So they make mistakes. That costs them big. That's why my business partner, Justin Guevara, and I wrote Beyond the Brand, The Entrepreneur's Guide to Fearless Franchising. It is our proven 6-step process at Franchisee to help you find the right franchise, avoid costly pitfalls, and build a business that truly fits your goals. Grab your copy of Beyond the Brand on Amazon or any major book retailer and start building your future fearlessly. Do I still maintain creditor protection?
Well, your creditor protection when you're in the plan, right? Yep. But if the monies are into your corporate checking account because you've done the transaction, then the stock that's held in the plans have creditor protection. But if the stock is worthless at the end of the day, it won't really matter, right? So the money has to get back into the plan to go back into a creditor protection situation.
Okay,
if that makes sense.
All right, got it. We have retirement assets being moved to a C Corp. We could get into later why it must be a C Corp. We're taking that C Corp, we're opening up a bank checking account, right? So that we now can move the retirement assets into some account vehicle so that I could pay the franchise fee, so that I could pay my rent, and I could do these other things with this account.
And then of course, a salary, right, Kristen?
I was just going to say, I like this. So I could pay myself a salary from my retirement plan. If I'm 30 years of age, I'm taking a salary and I'm avoiding the early withdrawal penalty, right? Mm-hmm. That's right. By taking a salary. That's wild. Okay. So that's the ROBS, sell the business, tax deferred. We have that level set now. No early withdrawal penalty, no state tax, no federal tax. buy a franchise using what was once, illiquid money. Your broker's going to tell you you can't. You can.
It really is something that if you're outside of the business, you don't know about. So I'm relatively new to Benetrends. I've been here under a year, but I had never heard of a rollover for business startup before I was introduced to Benetrends. And, I think that we sometimes take it for granted, but at the end of the day, it's not surprising that you would have individuals or brokers who say, oh, this can't be legal or it can't be something that you can do because you've always heard, as you said, that this money is in there and you can't get it till retirement. So it is an untapped area, and why, Benetrends is very bullish in terms of future growth, because there is so much unknown. There are so many unknown participants.
That's right. That's right. Well said. Going into this new iteration, if you will, of the ROBS, is this something you created at Benetrends? This is a proprietary model that you refer to as the ROBS Plus?
It is. And the ROBS Plus was conceived actually several years ago. So it was as the second generation ROBS, and we're the only ones that are specifically offering something that is certainly branded as ROBS Plus. That's our name. And there's no one else that is actively promoting this solution. And the ROBS Plus, at its initial design, was for the entrepreneur who didn't necessarily need to use retirement funds, but who wanted to take advantage of what we know to be the holy grail of investing, and that is Roth vehicle. So the initial idea was to allow access to someone who wasn't necessarily thinking about using retirement funds, but in doing so, get access to a Roth vehicle in buying a business. And that could be starting a business, buying an existing business, whatever it may be. But I think that to boil that down and to really focus, if your listeners get nothing else out of today's podcast other than one thing, it's that at the core, the ROBS Plus is a ROBS with a Roth. And it's a Roth option. And a lot of people understand Roth. They're familiar enough with it.
Tax-free, baby.
The tax-free aspect.
I like the way you worded it. It's like the ROBS is a person that I need the liquidity of my IRA, my qualified retirement plan, to do this deal, right? I need it. In this example, I could do this deal without it, right? I have a retirement plan, but I don't need to use that liquidity to do the deal. I have cash on hand. I have an SBA loan, and I also have the ability, because I have an IRA, to convert it.
That was the initial design. And so, we branded it as it's a capitalization structure designed around an exit strategy. Again, kind of focused on that back end with access to the Roth. What we've seen that really it is morphed over time into just another funding options that Benetrends has in their portfolio, such that we have many ROBS Plus transactions that are closed strictly on retirement funds, where it's 100% retirement funds and no cash, no outside cash injection. And I think that's important, because if it's just the wealthier entrepreneur that has access to it, well, then, turn off the podcast now, right? But the point of this is that everybody is different. Everybody's situation financially is different and has to be processed and looked at. But at the end of the day, if somebody wants to just use retirement funds and that's the only money that they have available to invest, they can certainly do that and still take advantage of the Roth.
Scott, I want to start with, you already started with it. I have a retirement plan. I don't need the retirement plan to do the deal. Great. Now that you have a retirement plan, let's take a piece of that IRA, which is currently tax deferred, and convert it to a Roth.
Right.
Right?
That's right. So in a hypothetical scenario, let's say that it's a $300,000 purchase, and in a traditional ROBS, so if you're looking at the diagram, it starts with the IRA that you have now, the pre-tax IRA, that is going to get rolled over into the new plan, and you're purchasing the common stock of this C Corp that you've created. The additional step that happens in the ROBS Plus is that those funds are now converted to a Roth investment. And so that triggers a tax event. And, we certainly want to talk about that, because you remember your IRA or your existing 401k that it is in a traditional vehicle is pre-tax. You made the point that 70% of that is yours, but there's that other portion that's going to go to the government when you pay taxes. And so you do have to pay taxes. Now, Benetrends has some ways to that we can demonstrate, if you decide to go that route, to defer some of those payments and do that over a longer period of time, so that you're not doing it right away. But I think it is important to remember that if you take that money and you're paying taxes on it, you're not going to use that money to pay taxes. You have to have liquidity elsewhere to be able to do it. So that's something to consider and be aware of. But once you do that, you have the conversion. So that goes in. Now, in our example, in that $300,000 hypothetical purchase, we've said that half was coming from the retirement funds and half was coming from personal investment. So you had cash on hand and you were doing that. And that goes in to, you're basically, again, you're buying stock of the company. That can be common or preferred stock. And again, that all depends on the individual and what they're trying to accomplish, and working with Benetrends to figure out the best format for you in terms of, or the best structure as you.
Okay. The consistency between the two plans, the C Corp must be created. Why don't we just address that now? Why does everyone wants to own an LLC and S Corp? Why a C Corp?
C corporation's required, right? There's that stock purchase, and we can't accommodate that stock purchase without the C corporation.
Okay.
Right. So that's the number one thing. You have to, anytime you're buying stock in a company, it's a C Corp.
Okay. All right. Interesting. So we have our C Corp. I don't want to get into the complexities of a C Corp and, tax efficiencies and whatnot. I know under this administration, C Corps were actually paying a lower corporate rate than some people. So I'm not even sure that this is a negative anymore. It used to be a negative in the, 80s, 90s, 2000s, but now I think things have changed there. So I have an IRA. I convert, in this example, on a $300,000 purchase structure. We're moving $150,000 from retirement money, and we're purchasing $150,000 of common stock in the C Corp. That $150,000 that was rolled out of an IRA was converted to a Roth IRA. Now I have a taxable event, which is I'm going to pay ordinary income taxes on $150,000.
That's right.
Does it have to be $150,000?
No,
No.
And we could have many iterations of this slide, and starting at 50,000 on the retirement funds.
Excellent.
Up to whatever you want. So yeah, there's a lot of flexibility there. It's really the design is yours, and where your funds are coming from, what means you have to do business. And we can get into, as we'll get into another example of where some of those other funds.
Okay. And to simplify, you now have a cash investment coming in, which is $150,000, which is, as you said, it's 50-50. Yep. We did 50% from the retirement plan conversion, and now we're bringing in 50%, which is cash on hand. And then that cash is purchasing. Explain the multiple classes of stock, right? You specifically went out of your way to mention that. So the cash is $150,000, and we're purchasing stock again in the C Corp. But explain the multiple classes comment.
Sure. So, and we can get into a little more detail about it, but fundamentally, when you think about it and you're buying common stock, and that's what if you're trading shares and buying stock in companies through your IRA, you're buying common stock. But preferred stock, it has more to do with priorities in terms of liquidation and that sort of thing, but it also carries with it par value and dividends that go along with preferred stock if you're buying that from any C Corp. You go out and buy Apple and there's a dividend as a preferred shareholder, higher rate or whatever it might be. But that's a complexity that most people that get into it don't necessarily understand or need to get. They can talk to their accountants and get into some of those details. But what it really does is it opens up some tax flexibility. So we've talked about ROBS Plus and the ability to have no taxes due. So that's on the retirement plan. If you're buying common stock, or if you're investing and using common stock, there is going to be a tax impact. So being able to structure the investment with preferred stock gives you greater flexibility and helps to maximize
I like that.
the tax savings.
The Roth conversion is straight up common stock. The cash injection can be a multiple classes of stock based upon tax efficiency, liquidity, right? As you said, par value, return of principal,
and
dividend
goals.
payments.
And I can give, we'll talk later on some examples on that,
cool.
why you might want to, what might go into the consideration of that.
All right. Okay. So audience understands 150 IRA, common stock in the C Corp, 150 converted to a Roth. We now have that tax-free vehicle that everyone wants. And everybody listening is saying, I can't do the Roth conversion. Why not? I make too much money. Wrong. Warren Buffett can do this. Anyone can convert an IRA to a Roth. So if you're listening and your knee-jerk reaction is that one-liner you heard from someone that says you don't qualify, you make too much money, your AGI is too high, not true. We're not talking about contributing to a Roth. We're talking about converting to a Roth. Anyone can convert.
Yep,
Deck of millionaires, Warren Buffett, I think, is the best example. Doesn't get bigger than that. Elon Musk can do a Roth conversion and take advantage of this types of strategies. On the bottom now, we have the cash coming in equal to the Roth, which is the 150 cash purchasing. The option is they're purchasing stock. The stock could be multiple classes of stock. We leave it at that. We now have a $300,000 fully funded franchise. Okay. Now let's talk about what happens and why this is so powerful as a tax strategy is now the results of a sale. We paid $300,000 for the business, and now it looks like we're selling it for $1 million.
Right.
Fast forward in the future.
Yeah, exactly. So, and again, these are just, we're keeping this example simple, but if we have $1 million sale, so you have a $700,000 gain. Now, imagine if you weren't using retirement funds at all. You didn't need to use retirement funds. You decided not to, and you were just using your liquidity or outside funding or whatever it might be. You would have a scenario then, obviously, where you're going to pay capital gains tax on those gains when you sell the business. And, that's also subject to, business. So there's some additional net investment income tax, state taxes, that sort of thing. So that goes to the territory if you're not in using a retirement vehicle. And I'm also, just for clarity, we're using a pretty simple example of a stock sale. Asset sales can be treated a little bit differently. There's corporate taxes, whatever product you're in, including the ROBS Plus, if it's corporate taxes, they will get paid on the gain. But again, using a stock sale, which is sort of what a seller typically wants to do, you have to convince the buyer. But again, that's on the side. So what happens is in the scenario where you're using your retirement funds, ROBS or ROBS Plus, when you have the initial sale, there are no taxes paid on the retirement portion of the investment because that's all rolling back into the retirement plan. With a ROBS, you are going to eventually pay taxes, as we've discussed. With a ROBS Plus, you don't. But in this scenario, and this goes, the second bullet really talks about the structure of the cash investment. So if you're doing that with $150,000, if you made that all preferred stock, it is being redeemed at the par value of $150. So there is no gain on your preferred stock. And so you do have a dividend tax that you'll pay because, again, Benetrends will take the structure of your plan very seriously, and you will have a dividend that is associated with that preferred stock. So Benetrends will do the calculations. It's cumulative. You don't need to pay it every year as you go along. You can wait until you sell your business, and that will be taxed. But the core of your investment, the $150,000, is back to you at the redeemed value, no gain. So the rest of the money, the $1 million that you received, less the 150, is $850,000 that's rolling back into your retirement plan. And it is not subject to taxes. And as long as you follow the Roth requirements, the two primary being that the Roth has been in existence for 5 years and you don't withdraw until you're at least 59 and a half, there will be no tax consequence.
Unbelievable. So you literally can withdraw $850,000 tax-free.
Yes, right. From your 150 investment of the cash plus the 150 that you had to start with the retirement funds. Now you have 850,000 that is Yeah, growing tax-free. And as it points out here, so it stays in the plan and you've realized that full profit and you don't have to take any minimum distributions within a Roth.
Right.
So the importance there, and the three of us are nowhere near retirement age. Well, Kristen especially, and Cliff and I are a little bit closer, maybe. But I didn't know about required minimum distributions, but the government setup is that you have to start to take monies out of your traditional IRAs, 401ks when you hit a certain age. And that's between 70 and 73, I think is the latest right now. I think it's
Right.
going up to 75 in 2026. But
Okay.
as we live longer, the point of it is that by that age, you have to start taking distributions from a traditional IRA, and they'll be taxed at whatever your prevailing tax rate is at the time that you make the withdrawal. So the nice thing about the Roth, even though when you do take the distribution, there is no tax effect, it allows you to keep that money in there growing. And that obviously can have significant impact. If you're required to take out $50,000 this year, that's $50,000 that you're paying taxes on, but you're also now, you have this $50,000, any of which is left over that you want to invest in another vehicle, unless you're finding a tax-free vehicle. You've had a tax impact, now you're investing it. It's comparing that to the $50,000 you got to keep in your Roth that's continuing to grow at some return, and whatever investment, that it could be another business that you've bought, that could just be stocks, bonds, whatever it might be, and it's growing tax-free.
And again, you could do this again. So you can leave it, you could take a distribution if you meet the requirements. You can leave it in there to continue to grow tax-free. I could also purchase another franchise, another business.
That's right.
Right? Do this all over again.
And frankly, we see that with our clients as they start to expand into multi-units. And they'll start out with their first one, and they'll use a ROBS or a ROBS Plus to start. And then they'll get into the next round. And through some of the methods that we can show you as a Benetrends client in terms of getting some tax saving strategies that may advantage you to get to that point a little bit faster in terms of some of the dividends, distribution, and that whatnot into your existing retirement plans, you can now create a second retirement plan and do it all over again, buy another unit or expand your business, whatever.
Scott, I have a question. If it's 150 and 150, the businesses own 50-50 by two different strategies, one being cash and the other one being the Roth. Why isn't the sale only 50% tax-free? How did you get the sale overwhelmingly to be a tax-free transaction?
So that's a great question. And that really goes back into the structure with the preferred stock. So had that been a common stock structure, then you would have split, and it was 50-50. You would split that gain half to the retirement plan, half to your individual investment. So you would be looking at $350,000 taxable event on 150, right? Because you take your $1 million, you say 500,000 there, 500. Because you did it as a preferred stock, you've created that structure that it's being redeemed at par value, and there's no tax effect on that piece. All that money flows back into. That's
brilliant. Okay, now I understand the emphasis you put on you're buying stock with the 150, but there's multiple, types that you're investing in.
Yeah, and so the next question that you might ask me, I asked it when I was trying to understand, well, why would you not do it that way? Why would you ever not do the preferred? So, well, because for one thing, you've taken this money, and you're 150,000, and let's say that you made your initial purchase when you were 35 years old, and it's 10 years later and you're 45, or even if 15 years later, you're 50 years old. You can't touch that money until you're 59 and a half. And some people will look at that and say, I want to have flexibility. I want to be able to access some of my money. And yes, I'm willing to pay taxes on a portion of it to maximize that, to have access to it. I want to buy a beach house. I want to, buy a motorboat, whatever it might be, right? So you don't want all of your money necessarily tied up into a retirement plan that you can't access until you're 59.
That is a great answer. This is brilliant. Great. Love that answer. Now I have clarity. I was struggling Now, I want to get realistic. A lot of people, I don't know, can relate to the 150, right? They need help. They need SBA. They don't have that kind of liquidity. Remember, that 150 triggered a taxable event.
That's
on
right.
the Roth conversion.
Paying
Not
a
only
lot.
do I need 150 to put up in cash, I've got to cover that tax burden I just created.
That's
You know,
right.
am I in California? Am I in Florida? Where am I in the world?
Right.
It's a bigger number. Let's talk about someone that actually needs debt. I want to go to that next slide we created with the $300,000 SBA purchase. By now, the audience understands we're going to take the IRA. I'm just calling it an IRA for simplicity purposes, a qualified plan that's tax deferred, and we're going to convert it to a Roth. Right now, we have a $50,000, way lower tax burden, by the way. Instead of 150, I only have 50. Same thing. C Corp's been created. We're going to buy the common stock with the Roth in the C Corp. Next comes my cash. As I said, the average investor is not sitting on a mountain of cash. In this case, they're only putting up 50. And they're going to buy $50,000, as we've discussed, of that multiple classes of stock. Hopefully, they don't need the money and they don't want to buy a beach house. And they're very close, let's say, to that 59.5. So like, you know what? I'm going to do this deal straight up tax-free. And in addition to that, they need an SBA loan for another $200,000. So we have on the retirement side, we have 50 coming in. And on the cash and debt side, we have 250 coming in. Same $300,000 deal, just structured differently.
Yeah, that's exactly right. Now, you know, one of the other things that the sales consultant at Benetrends would work with you on is obviously facilitating the SBA loan or whatever kind of financing, but typically on the SBA side with us, and the structure that the particular lender is comfortable with, and preferred stock, common stock. So there are a lot of conversations that are ongoing, but it will work. And you just, that setup that you have there is exactly right. And again, that you can do that with all sorts of iterations on where the money is coming from. So if the lender, if the SBA lender is requiring, let's say 70% or 30% of cash injection, you can have a $210,000 loan on the 300, and the 90,000 that you're making up can be any combination of retirement funds and cash. You could do 10,000 of cash and the other 80,000 in retirement funds, or vice versa. You know, again, depending on how much do you want to convert and pay taxes. You can also, if you really want to get crazy here, Cliff, you can do of those retirement funds, you can split that between converting some into Roth and some not converted. And so you can actually have a retirement plan that has both pre-tax and post-tax monies in them.
Okay. I want to walk the audience through selling, because I'm very interested to hear from you how you're handling the debt on the sale of the business, especially if the business sold when the debt hasn't even been paid off yet. But you'll tell me how you want to word that.
Sure.
So same deal,
yeah.
$300,000 business we've invested, very different. We only put up 50,000 in the Roth. We put up 250 between cash and debt. Business sells for $1 million. Fast forward, several years. Walk me through how this now works with return to principal or par value and then tax-free.
Sure. So in the example that we have on here, I think when we originally conceived kind of the example, it might have been 10 years down the road and the SBA loan was paid off. So in this particular example, there's no debt left. Now, in reality, maybe this is the SBA loan is still being paid down. Maybe you got another loan, whether it's SBA or traditional bank lending or some other sort of financing. And that obviously will need to be paid down with the proceeds of the sale. So if you sell it for $1 million and you still owe $100,000 on any kind of loan, that money is going to go to pay back and clear the loan before you have the final proceeds. But in this scenario listed here, we've assumed that there is no further debt, and that because you had $50,000 in cash that you put in, that's the only portion that goes back to you now. The rest of the proceeds, the $950,000, will all flow back into the retirement plan. So again, if there was $100,000 left on any kind of loan vehicle, then it would be reduced to $850 that's left over. So That's the basis there of and again, this is a pretty simple example of a transaction. There's a lot of potential, how you structure a deal when you sell it and all of those types of things. But in this scenario, that's what it would look like and how the money would flow back.
That's just brilliant. Talk to me about this little footnote. If the business is sold for $300,000, this is a third scenario where we're selling a business for really what we paid for it. Right. There's no gain. Right. Talk to me about the equity built up by paying off the SBA loan. What are you trying to say there?
So all that's really saying is that you're still walking away with, there's $300,000 as a transaction, and the $50,000 is going back to you as the preferred shareholder, and you had the par value, so you get that $50,000. If the loan has been paid off in full, you've paid off the entirety, you now have $250,000 from that transaction that will roll back into the retirement plan. Now, remember, you started out using $50,000 from an existing converted retirement plan, but you've paid down your SBA loan. So if you paid it all off, that's an additional $200,000. So all of that goes into the plan. So you've got $250,000 that will continue to grow tax-free and be available for withdrawal without taxes. So
that's wild.
Yeah.
Just paying down that debt and the way it's structured, preferred.
That's right.
It took that debt and converted it to a tax-free distribution on the sale, even though I sold the business for really what I paid for it.
Correct. Yes.
That is incredible.
Yeah.
That's incredible.
Absolutely.
The tax advantages of the ROBS Plus are really mind-blowing. And honestly, it almost seems too good to be true. I'm sure you vetted this thing 6 ways to Sunday with tax attorneys and so on, just for the audience, because it just sounds too good. What have you done from a testing standpoint? Like, has the IRS blessed it? Has the tax attorneys blessed it? What could you say there?
Yes, attorneys, accountants, it's been blessed because it's well within the rules. And I'm going to give you a couple of examples so that you can kind of put it back into real life. But let's talk a little bit about those tax advantages. We can sort of summarize that, and then I'll go back to your question. So we talked about you're paying zero taxes at the time of the transaction when you sell your business under this, and that applies to the ROBS as well. We said either ROBS or ROBS Plus. There's no tax up front. Later on, under a ROBS, of course, when you withdraw, you'll have a tax with prevailing rate you're in. But the ROBS Plus allows you to keep, if you structure it the way we looked at in our early examples, 100% of that money, those proceeds, with the exception of your initial investment of cash, will stay in the plan and grow tax-free. And when you withdraw it, no federal or state tax impact. No minimum distribution. We talked about that and the importance of that and why that can be a real differentiator from any of traditional IRA. And the other nice thing about this is that the Roth, as written through the IRS, survives both you and your spouse entirety of their lifetime. So there is no need to take a distribution. So if you have other sources of income or of being able to fund a lifestyle in retirement, you don't have to take any withdrawals. And again, if you have to, it's not a minimum, it's your discretion. And you still have 10 years beyond that for your heirs, who, typically children. And that last bullet is important because we all know that we've heard a lot about, especially over the last even 25 years, the amount of debt spending that we have, Social Security and Medicare under crisis. And it seems very likely the tax rates could be going up in the future. And the idea that you're in a Roth, you don't really care about the tax increases because you're not going to pay them when it comes out of that. And so that's an important differentiator too, as you look at what may occur down the line and thinking about where to put your money. I know people who have taken all their pre-tax money and paid the taxes and converted it simply for that reason, because they're worried about rising tax rates. So the power of this is a great example. You talked about Warren Buffett. I know you mentioned Elon Musk. The famous example, and some of your listeners have probably heard about this, but it's a very real one. And that's Peter Thiel. And many people know he was an original founder at PayPal. He and Musk were involved in that. And I think I maybe walked away with $50-60 million at the time of the PayPal deal, which, may not be a lot of money to you and Kristen, but it, seems like a pretty significant amount to me. And Peter Thiel, however this came to be, he had a Roth IRA that was worth about $500,000. And while this is not an apples to apples in terms of a ROBS Plus, because he didn't roll it into a business that he was starting and was going to be an employee of, because you do need to be an employee of this business that you're rolling a retirement plan funds into, because you've created a retirement plan. You need to be a participant in that plan. But it was a self-directed Roth IRA. And he took that money and he invested it in Facebook. And as of, I think it was 2021, that $500,000 was worth more than $5 billion. And now, 4 years later, I would assume, based on how the Meta stock is done, that Facebook now trading under Meta, that's probably north of $10 billion. Wow. And Peter Thiel, billionaire, will pay zero in taxes on that money. And, you can go onto YouTube and you can find the story and you can look at it and you can marvel about how that. And I'm sure that there are people at the IRS who are trying to find some kind of loophole, but this is how it was written. This is how it was designed. And so, the same principle applies. It is a Roth vehicle. If done correctly, if structured correctly, if you follow the rules of Roth, then it is tax-free. And, that's been vetted and looked at. And it's, we take our job as an administrator of retirement plans very seriously in keeping your retirement plan in compliance and making sure that it is going to pass any IRS regulations and rules.
That's a phenomenal story. And I'm glad you mentioned that, because you have 5,500 filings. This is an ERISA strategy. Like there's testing requirements and all of that. You're handling all of this.
That's right.
I don't have to do anything. I'm the I just want to buy a franchise. That's all I want to do. I'm not an accountant. I'm not a tax attorney. You guys are going to handle all this stuff.
Well, and that's an important statement that you made, because I do want to say that Benetrends, we are not a tax advisory service or tax experts. What we do is we work with your tax or your accountants or your financial advisors in doing that structure. And so I'm really glad you made that point, because one of the things that we do when we're vetting clients and talking to them about the ROBS and the ROBS Plus, if they're thinking about the ROBS Plus, first of all, any plan, any design that we're going to sell under a ROBS Plus structure is approved by upper management at Benetrends. So it's not something that is just done by a sales consultant or anybody in operations. It actually gets the blessing of management. The client in question has to be a willing participant to work with their financial advisor, to work with an accountant, to make sure that they're structured. We don't know the full financial picture of one of our clients. I mean, we can get what they disclose to us in terms of their assets, but what are their goals? What is their tax rate, that their tax class that they're in right now? What are other asset holdings that may not be known to us? So we're helping you and helping them structure in the most efficient way on the retirement plan. But it's always going to be important to involve your own financial people in that. But we are, in fact, administrators of retirement plans. We do handle the 5,500s for all the retirement plans. We have thousands of clients that we're filing those plans every year on our clients' behalf. And that's where, our expertise on the administration of that comes into play. So Benetrends is a funding company. We help you get funded. And people know us for that. And they say, great, I'm funded. I'm going to go run my business. But you've also now created a retirement plan at your new company. And we handle that retirement plan for you.
Okay. All right. That's great. That's great. Let's wrap up with some questions that I know people are going to ask. One of them is, why the $50,000 conversion? Like, why is there a minimum on the conversion? Like, you can't just do $5,000 and try and avoid a taxable event. You have to do at least X. Is 50 the minimum?
So that is our base guideline. As I said, we review every proposed deal. And so I won't say that there can't be some exception to that, but typically we want 50,000 to be invested from the retirement side. And, again, it really has to do with compliance with the IRS and the Department of Labor. And we're mindful of that when we're structuring a retirement plan. And as you said, using it simply as a tax shield, right, as a vehicle for that is not something that we are comfortable going into. So having a retirement plan, and, again, I think Peter Thiel, if somebody came after him, fine, he's going to win that case, but we're a little more conservative maybe than Peter Thiel in that regard.
Got it. Okay. That's excellent. So I should be telling my clients minimum conversion would be 50. Obviously speak to your advisors, but don't think you're doing this for 10. Okay. When I've done ROBS in the past, ROBS, not ROBS Plus, I want to distinguish for the audience so I don't confuse people. I've had a lot of spouses commingle. Like the husband's putting up 100, the wife was putting up 100. Is that a scenario here with the ROBS Plus where there's multiple Roth conversions coming in with a spouse, a couple buying a business?
Yeah, a spouse can roll over retirement funds into the new company's retirement plan. Like we said earlier, the ROBS Plus is really just a ROBS structure with the Roth plan. So similar principles apply here. Okay,
great. All right, that's good to know. That's very common. What about forget the spouse comment. What about me and an unrelated business partner? Can he and I commingle our retirement funds to do this in a partnership?
Yeah, both can roll in funds to the retirement plan.
I love this. I think we answered the question of what is the best way to buy a franchise? Is it a ROBS or a ROBS Plus? And I really think you provided clarity with the comment of, if you're 30 years old and you sell your business for $1 million, you can't touch that money and the ROBS Plus till you're 59 and a half on a distribution.
Well, so let me comment a little bit further to that, Cliff, because it's a good question. So remember that in reality, your retirement funds, whether it's a ROBS or a ROBS Plus, are off limits until you're 59 and a half, right? So if you start your business solely with retirement funds, any proceeds that come out of the sale are going to still be in the retirement plan until you're 59 and a half.
Okay.
So the difference in the structure of age where it does come into play is if you're making the cash investment and how you want to structure that. So when you ask the question, well, what's the best way to do it? You use a ROBS or a ROBS Plus. And the truth of the matter is that really depends on each and every individual. Now, if you told me, Cliff, that we get off this podcast and you said, hey guys, guess what? I have this great idea. I'm going to start Facebook too. It's going to be an AI thing and it's going to be amazing. And I want to do, well, okay, we want to get in on that. That's great. Right. And if you're a believer that you're going to be the next Peter Thiel, then of course you would do a ROBS Plus, right? And, in fact, I would say, hey, because of this podcast, they throw us a little bit of some of the shares of that Facebook.
Right.
But you don't know. We can't read the tea leaves. We don't really know what it's gonna wind up. So each individual has to do some assessment. They have to figure out, what is the purchase price of this business that I'm buying? What's my expected return? If you're buying a single store, and let's say it's $100,000 investment, and you could look at that and say, okay, I'm going to sell that business, even if you're going to sell that for a 3 times multiple or a 5 times multiple. Mm-hmm. The dollars involved aren't as significant at that level, right? So you have to really look at that, and you have to do the math with your financial advisor and kind of figure out, all right, I am going to save taxes. You're definitely going to save, but I'm going to pay a little bit more for the ROBS Plus. There's more to it. I got to pay the tax conversion. You have to go through that scenario. Now, a lot of times what you might say is, well, I'll start with a ROBS because I'm buying this business. I want to see how it goes. I want to see and you realize that, hey, I have a real opportunity here. If I just have this one unit and I buy it for $100,000, I'm going to sell it for $500,000. Okay, that's one thing. But if I buy 5 units over a number of years and I'm going to have $500,000 invested and I'm going to return $2.5 million at the end of 10 years or 15 years, well, that might make a lot more sense to do a ROBS Plus at that point, right? So you can certainly go down that avenue as well and start with a ROBS and then add a ROBS Plus to that scenario. So again, what's the business potential, I think, is an important thing. The other thing is, do you have the liquidity to pay those taxes? We've talked about that during this hour. If you have $100,000 or $150,000 or $300,000 in retirement funds, but you don't have a lot of cash sitting around because you put into your
That's right.
529 for your kids, or it's just daily living expenses and whatever, you may not be able to do it. Now, again, we can show you some ways to defer that, but the reality of it is you're going to be paying taxes on that sooner than you may have expected. So that's another consideration.
Okay.
The other piece that I would say is certainly the risk profile that any person could have, right? So you might come to us after the show and say, I got this great idea. We're going to do this. It's Facebook too. It's going to take off. And I might say, yeah, it sounds great, Cliff, and maybe that is, but you're asking me now to put some retirement funds in there. And I'm willing to risk it. As you said, I haven't paid taxes on it. So I'm sort of leveraging the IRS for that money, but I'm still a little uncertain about it. And I'm not sure that I want to pay the taxes on top of that money, because if this business adventure of yours fails, then I'm not only out my retirement funds, I'm also now out the money that I pay to convert those retirement funds. Right. So I've done it post-tax. So again, some of that is a risk profile. And the example that I talked about with the age of the person, again, we have a great example of somebody from earlier this year, a young woman, I think she was around 35, who had a great business plan, really believed in her projections. She thinks she's going to take this business that I think was purchased for under $500,000, might have been $300,000. She thinks it's going to be a $10 million exit when she's through. And I know she might be acquiring some additional units along the way, and she's going to have additional investment, but she really believes at the end of the day, it's going to be a home run. And so the structure was originally proposed as, okay, you're going to use a combination of retirement funds and cash. And for that cash structure, you're going to want to, for tax savings, you're going to want to make that preferred. And she said, look, I'm 35 years old. I want to sell this for $10 million, but I want to do it when I'm 50 because I want to enjoy life. And I don't want every single dollar to be tied up in my retirement plan. So I'm going to do some combination of preferred stock, common stock to go along with my retirement plan. And so I'm going to pay those taxes, but I'm going to have access to that money before I'm 59 and a half. So that's another consideration in that.
That's excellent. Great feedback. The costs, everyone's probably wondering, how much does it cost to do something like this? Are they the same? They're similar tax strategies. Are they the same upfront fees and monthly fees, or are they different, and how much are they?
So the ROBS Plus is more expensive than the ROBS through Benetrends. Mm-hmm. So you pay us $49.95 for a ROBS or $99.95 for a ROBS Plus. But one of the things that we try to get people to focus on when they're thinking about a ROBS Plus is really the tax savings is going to be a lot more than the $5,000 difference that you might pay up front.
Totally.
If the savings isn't there between the tax conversion of the tax liability that you have to do the conversion plus your upfront fee, plus it is a little bit more expensive to administer that plan. There's more work involved, especially with structures of stock. It's a little bit more, but the reality of it is that you have to be able to do the math to say that cost difference is minimal compared to what I'm going to save on the back end with the tax.
Totally. Absolutely. All right. And there's a monthly fee for all the 5,500 filings.
For the 5,500, yes. So we have a standard monthly for the ROBS and $30 more per month. So you're talking it's about a little under $400.
Okay, got it. All right, got it. This was great. We're up on time. I'm surprised it took this long to get through it, but it did. It's involved.
It is,
right? It's very involved.
And I would close with the idea that it can be overwhelming. It's overwhelming for some of the people at Benetrends just trying to get their hands around the whole concept of it. So again, go back to what I said before. If there's one thing that you take away from it, it's a ROBS with a Roth. And Benetrends will help you with the rest of it and working with you and your advisors.
I think you both did a fantastic job communicating this tax strategy to the audience. I think it's incredibly valuable. And I want to thank you both for taking an hour out of your day and family. And I know, Scott, you're on vacation. I really appreciate you doing this.
My pleasure. We're certainly excited to be here. And thanks for the opportunity to talk about Benetrends and ROBS Plus.
I appreciate you both. Thank you for joining me.
Thank you, Cliff.
Thank you for listening. If you enjoyed this episode, Be sure to like and subscribe so you never miss out on more great content. And if you're considering investing in a franchise, whether it's the brand you featured today or another opportunity, we're here to help. Visit us at francity.com. That's FRANOCITY.com. We love to help you take that next step towards business ownership. Thank you for listening. If you enjoyed this episode, be sure to like and subscribe so you never miss out on more great content. And if you're considering investing in a franchise, we're here to help. Visit us at francity.com. That's FRANOCITY.com. We love to help you take that next step towards business ownership.